My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, then please consider liking the video and subscribing to the channel so you get timely updates about my analysis. Very busy day and busy month in the markets. Lots of volatility, lots of things happening very rapidly, things changing. But with change comes opportunity. So there were 6 companies in my portfolio that released earnings today. I am trying my best. It is after 4 p.m. here on the East Coast. Trying my best to make a brief video of me reacting to earnings for each of them. We will see if I'm able to complete that before I get so hungry that I have to quit and eat, take a break. So, right now, we're going to be talking about Carlisle Companies Incorporated, ticker CSL. And of course, this is a company that I have covered on the channel one time before. I've also covered it with an article on Seeking Alpha. Now, as you might be aware, my viewers have the ability to access Seeking Alpha Premium for a discount using my affiliate link in the description of the video. But for those who do not have a Seeking Alpha subscription at this time, this stock, notably, out of all the analysts that cover the company, most have given it a hold grade. There have been a couple buys. After taking a look at the numbers and taking a look at the company, I kind of broke with the crowd and gave it a strong buy grade. There's only been 4 companies total out of all of the companies that I've covered on Seeking Alpha that I've given the strong buy grade to, of which CSL is one. And I did not do a review of the earnings the last time they did earnings, which was in February, or maybe the end of January. I didn't review it at that time on camera. So what I'm trying to do now is I'm trying to, for a lot of, the companies that I'm covering, particularly the ones that I'm giving such glowing reviews of, I really want to make sure that I follow up and stay up to date so my viewers and readers can get an idea of how things are changing, given the results of the business as they come in, because of course we know that markets are not static and they change every single day in some cases. So on January 14th of this year, I gave the stock a strong buy rating. It has outperformed the S&P 500 on a relative basis by about 350 basis points in total return. And while that isn't exceptional performance, it is relative outperformance. One thing that I do want to take a look at here is basically the idea for those who are not familiar with the business and have not watched my other video or read my article, which I, of course, recommend that you do. Prior to watching this, you get a little bit more background on the company. But basically, the idea here is that at one point in time, this company was more of an industrial conglomerate that had a diversified portfolio of business, though had a majority of their revenue coming from building products, specifically building envelope products. Think about siding and roofing and construction materials for residential and commercial, industrial, you name it, property, right? So I don't really like construction stocks. I did make that point known. However, the numbers that I looked at just looked too good, and I didn't want to discount that fact. So one thing that I noted in this article was that the company has a strategy that they've outlined titled Growth 2030. Vision 2030, the point of that is to divest away out of all of the non-product building businesses and transform the company into a pure play building products business. Transition it away from being more of a conglomerate, which some shareholders might really like that, some might not. The title here says it all, that the business transformation increases risks and rewards. The risks being that I think common sense wise, it makes the business more cyclical. However, the metrics of the underlying building products business produce superior rates of return on invested capital, which I really like when businesses focus on return on invested capital because that's ultimately what drives the earnings growth over time, among other things. But that has a very, very strong correlation to financial performance. If we can achieve higher and higher returns on invested capital in the business specifically, far in excess of our cost of capital, then we should appreciate, the stock shall appreciate, and we shall pay out ever increasing dividends over time. So that's kind of the thesis of management here with Vision 2030, is that the buildings product business has superior rates on invested capital, return on invested capital, and therefore they have decided to concentrate their business around that. So you see how the good and the bad that might come from that. In our prior analysis, we found that the the earnings multiple of the company has actually compressed over time. While many stocks, particularly industrial stocks, have seen multiple expansion over the years, Carlisle is not one of them. The performance of the underlying business has actually surpassed the stock performance over time, which I found particularly interesting. But even though the company has seen strong growth over the years, we see here dividends have increased from 94 cents a share to almost, well, actually $4 flat now a share. The company's actually been increasing dividends for almost 50 years. So it's been around a long time and it's produced very strong returns. So, anyways, let's get into the numbers. I'm going to go to the website. This company has a great website. Let's just let it load here. And let's take a look at their earnings. See, look how easy it was to get to the earnings presentation. These are fourth quarter results. And we need first quarter. Here we go. I talked too soon. This is going to be a longer video than the Philip Morris video, mainly because I have a substantially larger position in Philip Morris. Therefore, I pay substantially more attention to what's going on, and I know more about it. The position that I have in Philip Morris is over 10 times the size of Carlisle. Carlisle is one of the smaller positions that I have, given that it's more of a starter position. So before I get into this, actually, I do want to say the stock hasn't really performed well, despite the fact that it has outperformed the market, both on a year to date and since my strong buy call here. I would not expect this stock to. It's not a defensive stock. It's not a defensive compounder. It has proven to be a compounder over historical timeframes, but my focus has been more attuned as of late to more defensive stocks, given just my general outlook and perspective on where we are in markets today. So while I can't deny the strong underlying performance of the company, I have been prevented purposely from buying large amounts of shares because I don't expect it to trade up when the market's trading down in a sell-off. However, I do find the fact that it has outperformed the market, particularly in recent weeks, to be a good sign. In fact, if we go back a month from now, I'm totally going off on a tangent here, but we see it was 345 a share prior to Liberation Day. It traded $22 a share, down 8%, and it actually is up on a 1 month basis. There are a lot of stocks that aren't in that same camp. So despite the fact that it hasn't been the best performing stock in my portfolio over that time frame, it has performed relatively well. So what I meant to say when navigating here is I expect their earnings. I do expect their earnings to be kind of volatile. I do expect them to give muddied guidance. I do expect that there might be some tariff sensitivity here. All of those things are not what I necessarily want to concentrate into right now, nor do I recommend that for anybody right now. Although those are where the risks and potential rewards might be the greatest in today's markets. So, anyways, let's get into the earnings. First quarter overview. Revenues flat despite weather and market related headwinds. Resilient profitability with adjusted earnings per share of 361. Returned $445 million to shareholders through dividends and share buybacks. They did complete the acquisition of Thermofoam, Texas-based manufacturer of foam insulation. One thing that we talked about previously is that acquisitions are a core component of the strategy here of management. In fact, one thing that they highlighted here in the prior earnings report was that they expect $1 per share to accrete to shareholders from acquisitions, which is 6 or 7%. If I'm doing the math in my head, they have a earnings per share of 361 here. They had an earnings per share of 447 here. So we're looking at earnings per share between $12 and $20 off those numbers annualized. They're reaffirming the fiscal year outlook. I'm not sure what MSD revenue growth is off the top of my head. I should probably know that. They are still guiding for 50 basis points of adjusted EBITDA margin expansion. So reaffirming guidance, very important now, the current environment we're in now. Tesla famously gave their earnings report yesterday. I feel like maybe I should do a video about that because their earnings were horrendous. As it's basically a meme stock at this point. It did not sell off, which I'm not very surprised by, honestly. But they not only did they fail to reaffirm their guidance for the year, but they pulled their guidance for the year entirely. So any company that's pulling their guidance in the current environment is, I think it's safe to say that they are not confident. They are not confident in how the year is going to go. I want my stocks to reaffirm the outlook. Or in the case of Philip Morris, which I just made a video about 30 minutes ago and uploaded to the channel, they actually increased their guidance, which is not only is that going against the grain of what we're concerned about in this environment, it's exactly the kind of thing that gives us renewed conviction, I would say. So the fact that they're reaffirming their guidance, I'm very, very optimistic about that. This is just kind of some commentary on their, I guess, upside here. Mature non-residential building stock driving recurring re-roofing demand combined with U.S. non-residential building footprint by period build. So basically what they're saying here is that, hey, we got our work cut out for us here in a good way in the upcoming years because we got a lot of old buildings and those old buildings need roofs. If you're in the warehousing business, you understand how important it is to have a functional roof. You don't want leaks coming onto the customer freight or the customer goods sitting in your warehouse. That's not good for business. Mature non-residential building stock driving recurring re-roofing demand combined with increasing content per square foot producing an expected mid-single digit re-roofing CAGR through 2030. So drivers of increasing content per roof, adoption of newer building codes, regulatory push to build more energy efficient buildings, more severe weather events, widespread growth of 20-year warranties. The drive to become pure play building products, it's driven by return on invested capital, but it's also driven by trends that the company sees, both in the fact that there's just this long-term need for increasing capex, but also the depth of that capex, the content that they describe, the content per roof trends are up. But that's not really relevant to our analysis here. So revenue decreased slightly. Residential market headwinds. Unfavorable weather, I think, is the opposite of what we might think of as favorable weather. When weather is bad, there's lots of hail, storms, hurricanes, whatnot. That is a benefit to the company because they get more business. EBITDA margin down 240 basis points. We had lower volumes. So in other words, they have some fixed costs, but lower volumes. So their net margins were lower, negative price. And then they also made some investments. Lower organic earnings, share repurchases, accretive acquisition. But again, I don't expect earnings to plod along and be very consistent from quarter to quarter here either. So I don't really have a whole lot of judgment to levy on these quarterly results here. Then they break it down by segment. Of course, we have, as I pulled in here, or here rather, they have the construction materials segment and the weatherproofing technologies segment, CWT and CCM. The construction materials segment is a leading manufacturer and supplier of a complete line of premium single-ply roofing products and warranted systems and accessories for the commercial building industry, including polyiso insulation and engineered metal roofing and panel systems. And then we have the weatherproofing technologies segment is a leading supplier of integrated building envelope solutions that ensure superior building performance across both commercial and residential applications. From the tallest commercial skyscrapers to residential properties of all sizes, you have systems that manage the critical flow of water, vapor, air, and energy, providing cost-effective, sustainable, and reliable solutions for buildings worldwide. Mainly because I'm not a construction materials expert, I don't fully understand why those are broken out into two different segments, but they are. So the construction materials segment, we see that revenue is up, EBITDA is down, and margins are down slightly. Revenue drivers, the MTL acquisition, stable recurring re-roof activity, and accelerated orders. However, softer new construction or commercial construction, unfavorable weather comps, and lower carrier pricing. Again, I'm not. This is the risk factor I was discussing in the original analysis I did. Because we have tied the business so heavily to construction demand, we expect more cyclicality. So what we're seeing here is definitely not a dearth of demand. Carlisle weatherproofing technologies, much worse results here. Revenue down, EBITDA down significantly, EBITDA margin down, softer residential end market. Again, you see that slower new construction activity, unfavorable weather. And then we have deleverage on lower revenue. So operating leverage working in reverse. So those numbers really don't look great, right? They don't. No need to sugarcoat it. Here's what's interesting. You take 372 and net out the organic difference. That's like a 15% difference, right? But we're accreting 11 cents a share from our acquisitions. And then the share repurchases really coming in clutch. If we strip out the buybacks, what we're looking at is really just not a great quarter, if we're being honest. I like how they break this out. These numbers don't look great. Strong balance sheet. Let's see. They've got 600 million in notes coming due in 2027. 4.8 years of weighted average maturity, very low weighted average interest rate. They have pretty good liquidity, and it's within target. Operating cash flow, we see here slight loss in operating cash flow, but they increased CapEx. Free cash flow came in negative for the quarter. Okay, so this is the outlook. They reaffirmed the outlook. They're saying they expect to deliver record earnings per share for the fiscal year, exceeding 10% year over year. Mid-single digits revenue growth, pretty strong, and 15% free cash flow margin 2030, going out to Vision 2030. I wouldn't say that this is a bad quarter, but it's not a very underwhelming performance, I would say, in this quarter. And we have here CCM revenue up mid-single digits year over year on continued strength in re-roofing, and full year of MTL. That's one of their recent acquisitions. So in other words, they expect to accrete an entire year's worth of cash flow and through earnings per share. CWT revenue up high single digits year over year on share gains and acquisitions that they recently completed of Plastifab and Thermofoam. I am mildly skeptical, but I'm not mildly skeptical because I deeply understand the market dynamics of their underlying businesses. I'm deeply skeptical because I'm doing a very simple, smooth-brained analysis looking at the quarter versus what they're saying. definitely going to be paying attention to the upcoming quarterlies and seeing how they're doing. So what we do see, again, we're trying to answer, is the quarter ending in March typically softer than the quarter ending in December? What we're seeing here, 1.1 billion of revenue, down from 1.13 billion. So it decreased in that period there. And then we see here, December 2022, March was lower there. So yes, actually, what we see is that the March quarter is a historically weaker quarter than the prior quarter for sure. And then we see that borne out in the results here as well. So operating income here, operating income going from 212 to 124. So that's down 50% almost. And then we see here 255 to 224, much better results in the prior, quarter to quarter in the prior year. So one thing I want to note here is that we have our operating income. Not anywhere in in any of these quarters did we see operating income come in negative, and we certainly did not see that anywhere in our annuals here. But if I revert back to the quarterly, let me make sure I'm looking at the right number here. That's operating cash flow. See, their numbers there have some adjustments, so that's not necessarily an apples to apples comparison, because they're saying, again, operating cash flow of 156 in the first quarter of 2024. So okay, well, there's some adjustments to get us from these numbers to the numbers that we're seeing in Seeking Alpha. Do we have those numbers here? Revenue's about the same year over year, very small decrease. So revenue was flat, our costs went up, and then there's a small amount of foreign business. Here's the deal. I have more work to do. I'm really trying to get through these videos quickly today. I have more work to do to investigate whether or not I should care much about these results. I will tell you that my initial reaction is that I was very pleased with the fact that they reaffirmed their guidance. However, what I'm seeing in these current results, they don't look great. They don't look bad either. In order for me to understand if we have a potential issue here, is I would like to be able to see. I'm not saying I don't trust the management. The management is excellent in many ways based on what I can tell. But one thing that I want to investigate a little bit more is understanding the numbers behind the acquisitions. Again, we see here negative price cost. So they're saying cost went up, revenue was flat. It actually was a little bit flat, slightly down. Here they say strategic investments in innovation and Carlisle experience enhancements. So I guess what I'm saying is that I would like to investigate further a little bit more about these results, digest them a little bit further. And it has been 3-ish months since I've written about the company. So what I plan to do here is to write another article here where I investigate those things further. But I will say this, based on what I'm seeing, the market did seem to like the results. All of markets were up. We did underperform the market today. All markets were up pretty heavily today. We underperformed the market slightly. I feel like I need more information to be able to give an intelligent opinion. However, what I will say is this. These earnings are not strong buy earnings. I think what we're seeing now, again, we already have our position in the company. What I'm seeing here is, given the fact that I feel I need to analyze the company further, I'm not concerned about the long-term performance, by the way. I will say that. This is more about making an assessment and a judgment call on the existing earnings here. What I would like to do is assess that. But I think in the meantime, based on these results, what we're seeing here is we've got to downgrade the company to a hold. we've got to downgrade the company because they're not showing strong results. They're not showing poor results either. I would expect there to be headwinds in this market right now. I wouldn't expect construction activity to be strong. The management team has shown to be very adept at growing market share. Throughout all of that. The thing that I don't like the most is the fact that our margins are going down. I think what we discussed in the first video, we talked about the moat. I don't think it's fair to say that the company has a wide moat here because, again, it's, building products. So while I don't discredit their full year guidance, and I am encouraged by the fact that they are reaffirming that guidance, I think there's nothing about this earnings report that to me flashes that this company is going to this company, the underlying business performance is going to outperform the market over the next 4 quarters. However, we do see the company does seem to have a very good reputation and as such has still outperformed the market in terms of price and total returns there. So I've got to downgrade the company to a hold, mainly because I'm not highly encouraged by the results. And I will admit that a big piece of that comes from the fact that I don't have a very, very strong understanding of the underlying industry right at this time. That's why I'd like to reiterate that when it comes to position sizing, when you're entering into a new position on an investment, you can like the numbers and you can look at it very well. You must educate yourself as much as you can on the industry. This stock is a starter position in the portfolio. It's very small compared to some of the other positions. And as such, as the information comes in, that builds a foundation of education. But one should never enter into an investment with strong conviction without enough education or understanding of the underlying business to know the market forces that impact it. And I think that's where we still sit with this stock here. And so what I'm going to have to do is definitely going to have to downgrade it to a hold. I see no reason to sell or to, say that it's a bad investment prospect here. I still think that the valuation, again, we're at 16 times forward earnings. We have had great revenue, great growth over time. I think the strategy is very solid. I think the management team is highly competent. And I think that the long-term outlook is very strong. But in the immediate term, it has to be a hold. So anyways, I think the last thing we'll do is just give a brief kind of technical aspect to this. I actually really like the way the chart looks. I want to zoom out just a little bit more. I actually really like the way the chart looks. We've been in this, uptrend here. And I think it might even be fair to kind of apply this a little more broadly here. We've been in a pretty strong uptrend here ever since COVID lows. We've been trending up, with the exception of this bear market here. We decreased from 300 to almost to 200, roughly, a 33% decrease. We performed very strongly, and where we're at now is the price tumbled all the way down and tested this trend line here, and we've actually bounced. So far, we've bounced up off of that. So we know, based on looking at the chart, the stock price is highly correlated to the S&P, is highly correlated to the broader market. It's not in the S&P. It's actually too small. It's a mid cap. It's not big enough to be, a constituent of the S&P. However, we do see it is, strongly correlated to the broader stock market at large. So I think, technically speaking, we also have to reaffirm the status of the hold, because what we're seeing here, where so far it's bouncing, very encouraging to see that. And the fact they're reaffirming the guidance, everything. But the underlying business results are showing some things that are worth additional investigation. If the company were to miss guidance for the full year, I could easily see that being a catalyst for it to not continue trending up. Definitely something to watch. So I think technically we're still in the uptrend for now. But if anything, looking at the chart just kind of reaffirms that the status that it must be, downgraded to a hold for now. Hopefully, you've found this interesting, helpful for your own uses And again, I think the company shows a lot of promise. But there's nothing about the earnings report that was released today that makes me feel excited. There's nothing about it that makes me feel strongly convicted in the price. However, the great results of the business over time cannot be ignored. The way that the management has decided to pivot the business, while it does make it more cyclical, we're seeing that borne out in the results here. I also do think that it's informed by good data. That is it there. Downgrading the stock to a hold. There's lots of promise here. I think patience is very important here with this, given macro uncertainty. I think we need to kind of temper our enthusiasm on this particular ticker for the time being, and just be very patient about it. Thank you so much for watching. I appreciate all my viewers. My goal here is to return with an article that has a lot more information on some of the constituent numbers in the earnings report. Hoping to accomplish that fairly swiftly, but yes, please, if you follow me on Seeking Alpha, look out for an article on this that fleshes it out a little bit more. And if you don't follow me, consider following me on there. Thank you for watching, and I will see you soon. All right, bye.